As we were just talking about, U.S. markets look to open in positive territory this morning. There are signs the Fed has room to cut rates further, and fears of a bubble appear to have taken a back seat, especially with AI. Let's get more on this from Brad Bernstein, Managing Director at UBS Private Wealth Management. Brad, thanks as always for joining us.
To be here today.
Optimism for a bull market. Where do you start with that?
So, despite recent volatility, we maintain the view that the bull market is absolutely still intact. We see 7,300 by June and potentially 7,700 by the end of the year, driven by three things. One, yes, more Fed rate cuts. Two, continued strong earnings, and the AI growth story.
Let's start with the Fed rate cuts. It's gone back up,
Sure.
I think, about 70%, the odds right now for a cut coming up over the next little while. How many do you see, and how many would you like to see?
So we see right now 2 by the end of the first quarter. So there's 3 Fed meetings coming up between now and March 31st. We see at least 2. I think the volatility that we saw, that incredible reversal on Thursday when markets had a great morning, and then around 10:30, we saw them just fall apart and have a real ugly close on Thursday. Was probably caused by the U.S. government's announcement that the November job data would be delayed about a week post the December 10th Fed meeting. And then we walked in Friday morning, 8 a.m., and we saw the Fed, John Williams, vice chair, very influential, put out very dovish comments. That turned markets around on Friday. And we went from about a 30-ish% chance of a cut Thursday morning to today. It's actually about 77%.
And so a reason for optimism. And what happens, though, if we only get, say, one cut? What kind of a play is that?
I think markets, what we've seen over the last few weeks, the volatility that we've seen has really been caused by the uncertainty post the last Fed meeting with the hawkish cut that we got. So I think for markets to have a smooth ride, we need to have more continued understanding of Fed policy and rate cuts. I don't think, clearly if we don't get a rate cut on December 10th, I do think that would be a cause for some more volatility that like we've seen recently.
All right, and of course, the other big thing that's driving everything right now, AI, NVIDIA, we saw their earnings last week. They were good. They were better than expected. We still saw a negative reaction to it. Today, though, we're hearing that they may be able to start moving more chips to China. How important is that just for NVIDIA and for the AI itself?
Well, I think there's no doubt that what we're seeing is major increase in CapEx spending in AI next year. But what's more exciting for us is the clear evidence of monetization happening. Look no further than enterprise software, computer-facing applications that are generating revenue, as well as many leading cloud platforms have reported increasing revenue. So it's not just about the spend. We're really, we think the critical next phase of AI growth is the actual cash flow positive story that's starting to happen.
And how important is that you're seeing it across the group, not just NVIDIA, not just in one company?
Well, I think it's critical. I think it's critical for the rally to continue. It's important. Part of the volatility perhaps has also been the concerns around the continued growth, and not just the spending, but the actual profitability and cash flow generation, as I just mentioned. So I think it's critical for the rally to continue, that next phase does develop and continue to develop.
And is there room for all of them to succeed here, do you think?
Well, I think it's impossible for every company, in the AI space or in any space to be incredibly successful. There will certainly be winners and losers, but the overall story remains strong. The spending is undoubtedly increasing, as well as I just mentioned, the positive cash flow and actual profits and monetization starting to happen.
And what about the rest of the market to you? I mean, there's so much talk about AI, but what about the rest of the market, and what is it doing, and what opportunities do you see there?
So one of the positive stories that we just saw as we come to an end here in quarterly earnings season for the third quarter is that it's not just big tech that's having the growth. The median earnings growth rate in the S&P was over 5%, which is higher than normal. We saw earnings this year up about 11%, and now we're projecting overall earnings to be up about 10% next year. So earnings growth is across the board now, which is extremely encouraging going into the next year.
And just taking a bigger picture going overseas, you were looking at Japan, and that's caught your attention.
Yeah, well, we actually also just increased our estimates on Europe for next year. We just upgraded Europe to attractive. One of the big catalysts in Europe is Germany, who will be spending about 20% of their GDP on infrastructure and defense spending. So that's actually a big catalyst in Europe, and we think Europe looks really good going into 26. It had a great 25, but we think it'll continue next year.
And Japan as well, the spending plan there, your thoughts on that?
Yeah, absolutely. And I think what they're doing right now with their Fed policy also has a big impact on global markets right now. So Japan's very important, and we do like Japanese markets.
And how do you see, what kind of an impact do you see that having on the world markets?
Well, I think I think what markets like to look at is the yen to the dollar, right? And what they're doing with interest rates. And it has a huge impact on risk taking. There used to be the yen carry trade that's always had some, material impact on global markets. But outside of internally in the US, we also like financials, healthcare, and utilities as well in the US.
Okay, on that note, we'll leave it there. Brad, thanks as always for joining us.
Thank you.
Brad Bernstein is the managing director at UBS Private Wealth Management.